Hey everyone, welcome back to the Finmaneering channel, where we aim to simplify mining finance and engineering. Today's video is a follow-up from last week's video where we looked at the financial metrics of the New Gold acquisition by Coeur Mining. This video, part 2 of 2, takes a look at the operating assets from New Gold Mine. I will link part 1 of this series in the description below. Please check it out. We will cover a high-level overview of the New Gold operations, key risks, and some of the financial metrics associated with each of the operating assets. All data is as of early 2026 and based on the Q3 filing from 2025. So stick around, and if you like this sort of content, please hit the like and subscribe button where we do more mining breakdowns like these. Now, let's jump into the rest of the video. Just a bit of a quick recap on New Gold. The company was founded in 2005 and is headquartered in Toronto. New Gold is a gold-focused Canadian mining company. It has got 2 operating assets. The Rainy River Mine is a gold and silver open pit and underground operation, and the cornerstone of New Gold's production at the moment. In 2025, the operation hit a record quarterly production number, producing over 100,000 ounces of gold. The other asset, New Afton Mine, is based in British Columbia. It's an underground block caving mine. It produces gold and copper concentrate. Let's have a look at the production history of each of these assets. What we've shown here is historical data from FY23 and FY24, and then we've shown the last 12 months of quarterly data starting at Q4 2024 all the way up to Q3 2025, and then the 12 months to September, or Q3, as in the right hand column. What we can see here is that for Rainy River, production has remained relatively stable except for calendar year 2024. So this is looking positive. The New Afton Mine, we can see that production for 2023 and 2024, there was a bit of a ramp up. And then the 12 months to September 2025, production seems to be broadly in line with what we saw previously. Again, this is positive. If we combine the 2 assets together for total gold production, we can see that production in the 12 months to September 2025 is looking pretty good. And we can clearly see the ramp up in production in Q3 2025 that was mainly driven by production increases at the Rainy River Mine. Let's look at all-in sustaining costs quickly. Now, all-in sustaining cost is a measure typically associated with gold miners. What it measures is the cost it takes to produce an ounce of gold. In a company like New Gold that produces byproducts in the form of copper and silver, we sometimes see that there is a negative operating cost associated with the all-in sustaining cost. Really what this means is the company is getting extra revenue by way of byproducts, copper and silver, that offset some of the costs associated with gold production. It's important to note that all-in sustaining cost is not a metric that gets audited by financial accounting firms or the like. Each company sets out how it reports all-in sustaining cost, and it can vary from company to company. The World Gold Council does set certain guidelines, but there is a certain amount of interpretation that the companies have. In the chart, what we can see here is the all-in sustaining cost for both New Afton Mine and Rainy River Mine. Rainy River Mine, because it doesn't produce that much byproduct by way of copper specifically, doesn't have the byproduct offsets that the New Afton Mine has. And so in this chart, what we can clearly see is the impact that the byproduct credits has on lowering the all-in sustaining cost. In the lighter colors, we see the Rainy River Mine all-in sustaining cost component. The darker colors, we see the New Afton Mine. The line chart in black represents the collective or the combined all-in sustaining cost from both assets. The yellow line represents the top end of FY 2025 guidance, and what we can see is that the company, as at the end of September 2025, remains within that band. Next, let's talk about some of the key risks that these assets may face. First, it would be remiss of us not to talk about commodity price volatility. At the moment, gold and even copper prices are benefiting from geopolitical tensions and shortages in the world market. Naturally, a drop in commodity prices would hurt margins. New Gold does hedge some FX and fuel, but commodities appear to me largely unhedged, which meaning it's great for upside if prices keep going up, but it's bad if commodity prices keep going down. In any event, with the acquisition, the structure of their hedging and so forth may change based on Coeur's preferences. Next, let's talk about operational challenges. Rainy River Mine, in particular because it has open pit aspect to it, is subject to weather impacts. The New Afton mine, being a block caving mine, is heavily dependent on geotechnical and geological risk that really is essential for the cave to keep behaving as expected and thereby allowing the company to produce ore as planned. Block caves are designed to be boring and predictable. Effectively, they are rock factories. When they work really well, but any hiccups really impacts the process. Poor planning, particularly during the development of block caving operations, can be really detrimental, and an operation may not ever recover from these mistakes if implemented really poorly. Next, let's talk about regulatory and environmental risks. Both mines are located in Canada, but permitting delays or stricter ESG components may delay expansion projects into the future. Geopolitical and community risks. Partnerships with First Nations are important. New Gold seems to be doing a good job in this regard, but particularly with expansions and greenfield operations, First Nations agreements can sometimes become tedious and drawn out. Financial and expansion risks. If the company is acquired by Coeur, the financial and expansion risks shifts to Coeur. Coeur would likely have its own priorities and growth targets for expansions, and it may be in conflict with what has happened at New Gold to date. Do you think New Gold is a gem or a risky bet? Let us know in the comments below. Let's look at cash flow and cash balance. Cash has fluctuated but strengthened. It ended 2024 at about $106 million and then climbed to $213 million in Q1, $225 million at Q2, and then $123 million at Q3. This is after $260 million of debt repayments. As of September 2025, liquidity is around $500 million. That's cash plus an undrawn credit facility. We can see that free cash flow at times have been suppressed, and it would be something to watch out for if commodity prices falls or production levels materially decreases. Once these assets get rolled up in Coeur, obviously there'll be less visibility and the impact may be diluted, but something worth watching out for. Capital spending in 2025 was heavily focused on growth projects, and the company guided $220 to $250 million for the full year. So in summary, what do I think about the New Gold operating assets? Well, at face value, these assets, they're relatively small and likely would be a good fit for Coeur Mining. The challenge with these sort of acquisitions always comes down to operating culture and how these assets will be managed into the future. I'm sure that Coeur is a good operator and I have no concerns with this regard. As per my previous video, I personally think that gold prices are at the peak, and the timing of this deal therefore seems to me a bit off. If gold prices do come down over the next 12 to 24 months, this deal is going to look really expensive. Ultimately, no one knows how a rock will break, and it'll be really interesting to see how this deal pans out over the next couple of years. If you found this content useful, please like and subscribe and share this video, and keep an eye out for future videos where we dive into companies like New Gold. Until next time, see ya.